Welcome to Everything is FinTech. I'm Zach Anderson Pettet, VP of Fintech Strategy here at Money 2020, and that is the most preparation that we have for the whole show. Let's toss that over there and get into it. So, mortgage time. I wanted to ask this before we started actually recording. I didn't. I maintained the awkward silence as best I could as the podcast host that I am. How do you guys know each other? Because it sounded like as we were walking up, sounds like there's some history here. Sounds like you know even some about like Ian's background, known each other for a while. And I just slacked Ian, I think, 2 weeks ago and was like, we should talk about mortgages and we need to do a podcast. Give me the most interesting people that you got and let's just do this thing. And here you guys are. So how do you guys all know each other?
Yeah, so I mean, Ian and I did a podcast a few years back, right? When you were at CityWire. I think I know Bijna, you know Bijna, someone I used to work with back when I was in banking, and we had a great conversation about mortgages, and we've been in touch since. Yeah.
Okay, so your background's mostly banking before that?
Yeah, I was at Goldman Sachs for 14 years, intern graduate, kind of progressed through the ranks, and then decided to kind of leave that work behind and start Sprive. And then Andrei, we've met obviously we're in the same space, and then we're part of like a fintech founders group as well. So. Okay. Probably about 400 kind of fintech CEOs and get together.
Worldwide, or is this UK specific?
Within the UK specific, yeah. Within every quarter, a lot of fintech kind of CEOs get together and, we meet there and, if we can help each other, we will.
And of those 400, there's about 3 in mortgages.
Yeah, well, that's what I was going to ask. Yeah, we walked down to just grab coffee, and I saw you guys sitting on the couch, and I had this moment of like, I think that's them because I hadn't met you yet, and I was like, I wonder if that's like 60% of the mortgage CEOs in the UK, like sitting on that couch right there. Like,
certainly in the sort of small tech startup and mortgage space, yes.
Yeah. Why is that? Why is that not a bigger space? Why is that? Because it's not a small opportunity, at least from an American perspective. Like, it's a gigantic opportunity. It doesn't seem like it would be any smaller here, really.
I mean, look, I have to go through a bit of a history lesson.
Give me some history. Give me some, I can't stop myself. Every time I go into the tube, I'm like, I wonder what this was like in the 40s, so take me there.
It's okay if we don't go that far back.
I was hoping we were going to the 1800s, but all right, fine. If you want to be more recent, go ahead.
I was going to go to like 2017, 2016,
okay.
Right? Which is basically where I think mortgages first started getting some proper attention from venture capital. Mm-hmm. And you had some really exciting digital mortgage brokers like Habito, Trussell. I actually ran one called Dynamo at the time, and just a lot of money got plowed into mortgages. Really good time for venture capital and fintech in general. And a lot of those firms just didn't quite kind of meet the expectations of what their business cases said. It was really hard to acquire mortgage customers, and the cost of acquiring them just didn't add up to the lifetime value. And as a result, I think fundamentally VCs just got a bit burned by investing in mortgages. And as a result, over the last few years, a lot of people have tried to raise in mortgages, but the memory of being burned by investing in a few of those in 2017 still was left in investors' heads. I think we're seeing it kind of come back now, maybe. What do you think?
Yeah, I mean, I completely agree with that. Like, I've spent some time raising. We're about to close our round. And there'll be a lot of investors who really like what we're doing at Sprive, and I can talk about what we're doing if that's useful. But they just have that kind of the war wound, especially if they've invested in the likes of the kind of the 2 big ones, like you mentioned, were Habito and Trussell, and they raised a lot of money. And when you've got like an institutional investor, they're investing in a business that ultimately will generate like 100 million revenue, be it a unicorn. Have valued at least $1 billion, and those companies got nowhere near that. And some of the players got had to like exit the market, distress themselves. And so when money's been plowed in and people found it difficult, they're like, well, why will someone else who comes into the market be any different? And it just forces the people that come in to be really focused on having a different strategy. Because I think what we found is that the mortgage market, especially from an intermediary standpoint, is very fragmented. So it's very traditional. You've got like 20,000 mortgage advisors in the market. And so when you take a step back, you're like, well, is that right? Because for certain transactions, people might argue that technology can do a good job, just as good, or maybe even a better job. So why does that exist? And I think what we found is the cost of acquisition is very, very expensive, but also I think the traditional market did a very good job of holding on to their customers as well. Yeah. And that's just kind of played a part. Less players operating and trying to do interesting things.
Yeah. So let's go there. What do Koodoo and Sprive do? And we can start in either direction.
Yeah, you go first.
Yeah, sure. I'll take over. So So we do a number of things. We actually started our life realizing off the back of this Dynamo broker that acquiring customers was probably the most important job to be done for any firm working in mortgages. And I would maintain that it still is.
In fintech,
Right.
I think that's brought
Totally.
like just
Totally.
acquisition is the thing, and distribution is the thing that we just like can't figure out and get to the scale of a Goldman because of.
100%,
Yeah.
right? And so we actually went to the price comparison websites and we said they do a terrible job of mortgages. Most of the time when you went on a price comparison website back then, you just get a form which says fill in this form and somebody's going to call you. So you weren't able to actually compare prices on a website, which is kind of the whole point of the price comparison website, right? So we just built that for everybody. So now we power Compare the Market, Go Compare, ClearScore, Experian, Times, there's a few others as well. And started working with lenders in the market to give them direct options. We have a brokerage that sits underneath that as well. And we also realized that we are quite good at building technology. So started working quite a lot with lenders across the market to build their technology for them. And in the last 3 years, we've been doing a lot on AI. But I'm kind of going to pause there because I feel like the AI element is a whole nother thing that we should talk about.
We can put a pin in that and come back to it.
Yeah, and for me, it was. I remember when I saw kind of the likes of Habito and Trussell kind of entering the market, and while I was at Goldman Sachs, they invested £14 million actually in Trussell, and so I kind of got to look at the mortgage market kind of from an investor standpoint, and realized like huge opportunity but massively fragmented. But I did see that the cost to acquire customers is just so expensive, and so we were like, how can we help people manage their mortgage in a much more cost-effective manner? And at the time, we saw apps like Moneybox, Plum, Chip. You know, some of your listeners may know those apps, kind of auto-saving investment apps. And it was like, why couldn't we do something similar, but for mortgages, where we're helping people put spare cash towards, instead of investing, paying off mortgage debt. And so we built that. We entered the market. We started acquiring customers. But then the unit economics was pretty challenging. The macro environment, the interest rates rose quite aggressively. I don't think ever, none of us predicted that the rates would rise the way they did.
SVB definitely didn't.
And so we started getting customers basically saying even like coffee a day, trying to put that towards the mortgage is really like challenging. And so we came up with a marketplace within the app, which we call Shop with Sprive. And the idea is anything you do in your life, you do it through Sprive. So we work with like Amazon, 7 national grocers, Primark, John Lewis, like 65, 70 top tier brands. Every time you shop at those brands, within 15 minutes, you get money towards your mortgage. And so across the spare cash and the kind of marketplace shopping feature, our customers are on track to save something like £118 million in interest and not 22,000 years off their mortgage. So pretty impactful. And our cost per acquisition, thank God, is very, very efficient. And so, now we're looking to scale. We feel like, most homeowners want to save money on their mortgages. So, we can help them do that. And we do other things like we scan the market every day for better mortgage deals. If we can help you find a better mortgage deal, we'll essentially help you get that.
Yeah, and you know what? Hi, everyone.
Hi, Ian. You're just waiting for his moment, wasn't
I
you?
was, yeah.
I love
Hi,
you, Ian.
I'm Ian Horne, EU Head of Content at Money
I
2020.
love you.
Hi, my interests include football and writing. Anyway, so Zach, you asked me to invite 2 interesting mortgage people who obviously within 5 minutes haven't let me get a word in.
You did that.
So I feel like I've succeeded. So there was a reason I've invited these 2 wonderful gentlemen. Obviously what Jinesh does at Sprive is really interesting, right? I'll give you a second here. So what we
There's something about you that, like, every time you get on stage, every time Ian gets on stage in Money 2020, I don't know what it is. Before he says a word, I find it funny. I don't know why. Like, and he's not even trying to be funny at that. And he's a genuinely funny human. But there's something about that moment before you say something that's just, and I don't know. It just happened. I don't know.
Trademark British awkwardness.
That is what it is.
Enjoy it. Embrace it.
It's so good.
Live with it.
So nice to meet you, Ian. What were you gonna say?
I was going to say some wonderful stuff. So yes, these two guests. So Jinesh, what you're doing at Sprive, obviously I interviewed you about 2.5 years ago, maybe 3 years ago now. But what appealed to me about what you were doing was you made it really easy for people to see, 1, how they could change their mortgage provider, and 2, the compounding bit that we were talking about on the previous podcast.
The overlap of these two is actually really interesting.
It's literally, if you spend X amount more every month, you will save X amount of time and X amount of money on your mortgage. And as you're saying, 150 million saved, right, for customers. It really is that simple. If you can map it out to people, especially for a long-term product like a mortgage, if you spend another £50 a month for the next however many years, with the interest that adds into that, you're saving so much money. So I think what I love about what you did is actually the core product's really simple, really straightforward, and helps people actually engage with their mortgages in the way they otherwise wouldn't do. Because so many people are on the wrong mortgage, or they're not, or they're paying interest only, or they're not really thinking ahead to the future. So that's why, I wanted to get you back on. Obviously, the podcast was good fun too. Yeah. Andre, I mean, I saw you speaking at Fintech Fringe. You were doing an AI panel with Chris Holmes, who's written the AI bill, I think, for the UK.
That's right.
So you were like, oh yeah, I'm this interesting AI guy. Oh great, cool. And then turns out you're a mortgage guy.
That was a great impression.
But I really.
I was like,
yeah,
spitting image.
I got the Irish lilt there, didn't I? I really nailed that. But no, obviously, really interested about what you were saying, and I think the opportunity to bring AI into the conversation, as you're no doubt going to, is really interesting. So. Yeah, so there's my little hello. But
Sorry, forgot, mate.
No, it's okay. It's all right, I'm upset. It's only my feelings.
I love it. But I think that, like, the Sprive side, it's interesting because, I mean, we were just I'm going to probably end up correlating a couple things to wealth management because we were just sitting in here having a conversation about wealth management. And when you think about, like, to oversimplify what you're saying is, for an American especially, is like Acorns for mortgage that's brand facing, right? Like, with a spending focus. And one of the things we were talking about is, like, how do you find a hook into an everyday kind of more, not sexy, but like at least like entertaining kind of dopamine driven thing that leads to a responsible outcome, right? And Acorns is an example of it. But the idea of doing that for a mortgage, for most people, like that's their, the most significant asset that they have. And if they could pay that off earlier, it makes a way bigger impact on their retirement than actually probably saving for their retirement, right? So, like, the idea of that side of things, it seems very interesting, and it's very un-American because I haven't even heard the term overpayment before. We don't do that. Yeah. So, it's unique and it's interesting to think about.
Yeah, I think most of our customers don't even know they're making overpayments. I think they just like the idea of trying to save interest and when you see that, you can visually see that I'm on track to pay off my mortgage 3 months earlier, a year earlier, 2 years. It becomes like, well, that's something I really would like because I mean, let's face it, who wants to spend their kind of 50s and 60s and 70s even worrying about a mortgage? You never know what's going to happen late in life.
Right. You
could lose your job. You could fall sick. And the key thing about Sprive is that it's without impacting your lifestyle. And so we tried to do something different because we knew that if we did something similar to what others have done before, our cost per acquisitions would be really, really high. And we wanted an app, something really sticky that just kind of lived with you every day, every week. We felt like the mortgage market generally interacted with customers every 2, 3, 5 years, very transactional when you're looking to remortgage or when you're first buying your home. And we wanted something where you're touching us and you're interacting with us every day, every week. We're part of your life. And we thought that was key because if you don't have strong engagement, you don't really own the customer. And they don't love your brand, then you don't really have the customer. They can go elsewhere. You fail to monetize them. And so we're focusing on acquisition and distribution to try to change the way the industry exists today.
Yeah, has your proposition kind of had a demographic difference in how people respond to it? Because I'm wondering if your main market is them first-time buyers that you're mentioning, or if it is actually people that have had a mortgage for maybe decades even, and they're like, oh wait, I've been maybe doing it wrong the whole time. Do you have a sweet spot there?
Yeah, so you have to have a mortgage to be able to use the app. So if you're looking to get onto the property ladder, you can't use our app. So we support 14 of the kind of top lenders in the UK. So all your kind of household names, the Barclays, the Santanders, NatWest, Nationwide. So you have to have a mortgage with one of those. In terms of people, we tend to find average age around 38. So we tend to find people who are quite young in their mortgage journey. Probably similar to me. When I had my mortgage, my wife and I bought our first home about 12 years ago, and I vividly remember seeing the mortgage offer document, and it's saying for every £1 that we borrow, we'll be paying 50p in interest. And this was when interest rates were the Bank of England interest rates were 0.25%. Obviously, they're a lot higher now. And so people just have that kind of stress that I know I'm paying a lot in interest. And then when they hear about, most of our growth is word of mouth. We've spent very little marketing. Just people down the pub saying, you should check out this app. I'm on track to save this much in interest, not this much, this many years. And so that's been really kind of solid. And now, we're getting institutional capital to okay, this is working. The unit economics is working. Let's go big.
Were the brand deals hard to build, like in terms of the Amazon and all that you were talking about?
Yeah.
It took some effort, I'm guessing.
Yeah, it takes a long time, like a lot of rejections.
Yeah.
So it took me I won't mention names, but like certain brands took me over a year to convince them. A lot of times they would say no. A lot of it's on the data. So like in the US, if some of the listeners are kind of familiar with that, I bought it in the US. They had a strategic investor, Walmart, where essentially for people who may not be aware of the company, you scan your receipts and then you get kind of cash back on grocery shopping, and that was a great partnership with Walmart and iBot, and they IPO'd last year. And so there's compelling use cases for why grocers and other brands should work with someone like us.
Yeah.
In terms of demographic, mortgage holders are customers that brands want. They generally, obviously, they have mortgages. It's hard to get into the property ladder. So from an income profile perspective, you're probably slightly better than maybe a renter from a brand's perspective in terms of you have more discretionary spend. And so it all kind of aligns. But it's been it's taken a while. It's not something you can just turn up to brands and be like, yeah, let's just work with us. It's it's
probably a tipping point, right? Once you get enough volume, then they start coming to you.
Now there's some really interesting brands in the pipeline that we're doing. And the tipping point is now we found a major brand, which I can't talk about now because it's not done, but where they are like wanting to promote us to their audience, and stuff like that is really good because that's kind of like revenue-led growth, and your acquisition becomes very, very nice. So we're having to go about it a very different way, but it's taken time. Like we met a few 2.5 years ago. We've been in the market just over 3 years. So it's been when you're trying to innovate in the mortgage industry, there's no like easy wins. You either like have to like graft and go through it the hard way. Otherwise, it's challenging.
I have to comment on that and just agree wholeheartedly, right? Like if the audience for this podcast is anybody here potentially thinking about going and finding funding for a mortgage startup, be really careful on your assumptions around your acquisition of either customers. We talked about that around sort of the cost to acquire customers. It's a lot harder than it seems. But if you're going for the B2B play, it's not going to happen in 6 months. It's not going to happen in 12 months, right? The sales cycles in mortgages, particularly if you're going after the mortgage lenders, you've got to be talking 2 or 3 years. And that's really difficult to do if you're just doing traditional VC-backed.
Yeah, it's hard to talk a VC into, really it's going to take me 3 years to peel back one layer of risk, and then I'll be able to do something. And then in 10 years, it'll be a multi-billion-dollar company. Just go with me, you know?
And also building technology in the UK is expensive. Like getting developers, getting like even marketing, everything's expensive. It's not like, and so like you've somehow got to find the capital early and then grind it and make it efficient and get to your kind of your milestones. And I've seen so many founders try to do things in the mortgage space, and over time they've all most of them have kind of fallen away. And a lot of the players I'd say are gone kind of B2B, and then dabble in kind of B2C. But a lot have found ways to like stabilize and use clever distribution like you've done at Koodoo through aggregators and. I think it's kind of this. I feel like who's now in the market is like really strong players, survival. They've kind of gone through the hard times.
So I have a question for you two. I guess it's a podcast, so no shit. I have a question. Does in the mortgage tech world, or like the mortgage world specifically, does product market fit or distribution market fit matter more? I like it.
I mean, I would say that you've definitely found a customer product market fit, right? With your sticky app and sort of helping, like if you've got people telling their mates about it at the pub, right? That's a really good sort of indication of that. I think distribution market fit can also be as important if you're doing things that are slightly more commoditized. So if you're like us, if you're providing mortgage advice is quite difficult to really differentiate because it's quite a standard process that's set by the regulations. So unless you're doing something really, really wacky, which the regulator may not want you to do, it's more likely to be defined by your distribution, your leads, how you process them, and your funnel.
Yeah. I mean, I'd say like traditionally, if you think about the mortgage market when it comes to distribution, is most people, especially mortgage advisors, they do when you're buying your first home, that's when they kind of look like get you, and it's a really emotional like and a aspirational thing to be able to get onto the property ladder. And so when you've got someone who guides you through that, and at the end of it, you've got it might take 2 months, but at the end of it, you've got your keys, and that person's been key to kind of help you guide through that because you've never done it before, and you just want to make sure that you get the house of your dreams. They build that connection. And then from then on, that the advisor's hoping that even if the interaction's every 2, 3, 5 years, that you'll come back to them because you help them, with that kind of that key point in their lives. And that's how distribution generally in the mortgage industry kind of plays its part. And in terms of like estate agents and like property developers, and there'll be other like solicitors. I'm sure there's other like players that help with distribution in the traditional way. And that's kind of really kind of rock solid. So when you come in from a technology standpoint, you're like, well, how do I create my distribution? And that's a little bit different. Like aggregators is a good one because a lot of traffic goes to these comparison sites and people are just searching for mortgage deals. But then the product market fit around distribution for someone coming in is fundamental to be able to like make this a success, because that going cold market, people have done it and proven that it's actually impossible. So unless you do it a different way, it's just not worth doing it. Like I was amazed like 4, 5, 6 years ago how many people try to do the same thing and expected a different outcome. It was like madness.
I mean, we were literally there doing it, looking at our Google ad spend and being like, why is it costing £1,000 to acquire a single mortgage customer on Google? Oh wait, it's because Habito is also doing it, Trussell's also doing it, and we were all just killing each other. And for context, I don't know if anybody knows the economics, but like usually you earn about £800, £700 on a mortgage customer. So just the number one rule of unit economics is just flown out the window, and yet everybody was still plowing money into it, right? And obviously now it's a bit different because the likes of Habito and a few others have really great brands that they've invested into, and they can get some of those customers organically. But it was a crazy time, wasn't it?
Yeah, it was a crazy time. So I think like product fit around distribution is like core and is essential. And if you can do that through partnerships, fantastic. And if you can do that through direct acquisition, fantastic. But to do anything in this space, you need to have distribution. It needs to be reliable distribution. It needs to be cost-effective distribution. And without having that as a foundation, you've got nothing.
But looking at like partnerships, one thing we were talking about in the last podcast was this idea of seeing all of your finances in one place. Like your mortgage is a really core, if you have a mortgage, it's a really core part of your financial plan. So when it comes to distribution, is there a reason why banks aren't quicker to fully integrate this into people's kind of investment oversight and so on?
So look, my prediction actually is that we are going to see a huge consolidation in the mortgage market towards some of the new banks. So it is unconceivable for me to not see Revolut, Monzo, and Starling launch their own mortgage propositions, not just in advice, but probably also in lending, in first charge, but also probably in second charges. And I think we should definitely touch on the second charge market because it's a really interesting.
Can I ask you to define it? Because maybe I just don't know mortgage well, or maybe it's a UK thing, but I don't know what you mean.
Great. Fantastic.
I'm willing to be the dumb guy. Go for it.
So second charges is basically like HELOCs in the UK.
Oh, okay.
Right?
Okay.
They work a bit differently, and people have tried to bring over some HELOC propositions here, but
basically you're layering a mortgage. You're layering a mortgage on top of a debt. Yeah.
Exactly. But the problem in the UK fundamentally is that so many people opt for really expensive unsecured debt when they have a house that they potentially be borrowing against. But a lot of the mainstream lenders don't really allow for like a flexible borrowing facility on their mortgage because of the fixed terms. Whereas second charge mortgages can either help you consolidate existing unsecured debts, and you consolidate it at a much lower rate but spread over a much longer term. So your actual monthly payment comes down dramatically. Or if you're looking to finance something else, like get a new kitchen or get this or that, again, it can be a really good way rather than going unsecured. It's a really small market in the UK relative to how big it is in the US, but I think it's definitely one to watch because it's such a great consumer proposition. Like, if you have a house, you have access to that credit, why would you not get it for a fraction of the cost of what a lot of people are doing today?
And the idea of like a
revolving.
I was about to say Monzo and Revolut in the same word. Revolut, Monzo, Starling, doing something like that. Like I would hope, assuming kind of knowing those brands, that they would do it in a responsible fashion that would actually be transparent and show you that you are doing something positive for your economic life versus like when I think of a HELOC in the US, I don't always think of it as a positive economic decision. But what you're talking about sounds like if you have, a little credit card debt, whatever it is, like actually a very responsible decision that if you're living inside of the Starling dashboard or whatever it is, that's it's like the trust is there, the cross sales very obvious, like the share of wallet, like that all makes a ton of sense.
And if you think about those three as well, right? First of all, they've all become, well, some of them have become banks recently. So suddenly mortgages are quite attractive to them from a capital adequacy point of view, right? And reg cap.
Where else are they going to get the NIM? Like the net interest margin has to come from somewhere. And
And got access to all these great deposits, which probably they're struggling to find a way to deploy, right? Maybe. But also, they just get access to all of these amazing consumers that already put so much trust in them, have access to their data. So from a distribution point of view, they don't have to pay anything on those customers. They don't have to go out to try and market on pay-per-click or work with any third parties. They've already got them and all their data.
So now educate me on what it takes to actually stand that up in the UK, because in the US it's, sizable, but also we were talking about this a little bit before, regulation shifting in a direction in the US where maybe I just decide that I want to do that on a Tuesday and I can go do it without anything in like a year. But doesn't sound like that's true here.
I'm so glad that you asked, because I actually one thing I missed out, right, is while I was doing Koodoo, my investors also said, "Hey, second charges looks really attractive. Can you launch a second charge lender for us?" And I did, and I got the regulations, I got the team, I got the debt funding, everything. But I launched it on the day of the mini budget, on literally the day that the entire economy went kaboom. And we didn't write a single mortgage, thankfully, because we just had no idea where to price it. Like, should we do this rate? Should we do that rate? I don't know. But it's not easy, right? But you could probably do it in 18 months. But the regulatory process is significant.
How much money ish are we talking? Like over $1 million, a couple million?
Yeah, you probably need about 15.
Okay.
Yeah.
Okay.
Mix of equity and debt.
Yeah. And then
the problem is, like, if you start off with having a really good funder, right, like one of the neobanks that already has access to deposits, it's a lot easier. But if you're trying to do a standalone, and there's been some really impressive second charge entrants into the market who are doing a standalone, you have to find somebody to fund the first part of the debt with equity, basically, right? And then you find your first funder who's going to do it on quite a high rate until you can then find an institutional investor or sort of do some warehousing. So
that's what I was going to ask, is how much do you actually have to do a loan, right? Like that's like to set it up, to have the licenses, it sounds like 18 months, 15-ish million, something like that. But like to actually deploy any capital into the world is a whole different thing, right? Like starting a bank in the US probably costs, well, if you can get a de novo charter, probably costs like, I don't know, $40 million, something like that, $50 million. But to actually be able to build the balance sheet to deploy any of the capital that you hypothetically are going to hold in deposits is like a whole different conversation. So I think like the numbers that we use to like get the license and stand a thing up is often very, like we miss a layer of complexity there sometimes, I think.
Yeah, I agree.
It's interesting.
Yeah, I mean, you see, you had like even the supermarkets, some of them Tesco's and stuff are trying to get into mortgages and stuff, and they found it challenging, and they kind of dialed that back. But I do agree with you. I think, Andre, I think the all three of the fintechs that you mentioned will definitely, I can't see them not going into mortgage lending, and then they'll be taking on the the more traditional kind of top 10 lenders that we have that feel like they're in a very fortunate position right now where they have a good 85% of the market, and when it comes to innovation, they've probably felt like they haven't had to do much because their positions are rock solid, and they've got 20,000 mortgage advisors giving them distribution. Once there's suddenly there's change, that's when they're probably more likely to like innovate and do things. Because for anyone listening who's ever taken a mortgage in the UK, it's a painful process. Yeah, first time buyers buy process is painful, but even remortgaging is painful. Like it can take up to 8 weeks, and you're providing you can provide like huge amounts of information, giving it to an advisor. The advisor's taking that information, punching it normally like manually into like a lender's website. Lenders, banks have like 3,000 employees at these major banks, so their underwriting team verifying the information. Then ad hoc questions. They've got like BDMs across the entire country to manage the relationship. The mortgage advisors will have questions around your criteria, and the whole thing is just is hugely expensive for banks. And when new players come in, and if they can compete on the balance sheet from a balance sheet perspective, that's when I think things will start to really move, which is good for us. In that when they start to move and they start to see, okay, there's someone here who's going to eat my lunch. Then they've got to like differentiate themselves, and pricing at the moment, like it's hard to like differentiate yourself when it comes to a mortgage. Like
it's commodity, right?
It's a commodity. It's like even now, like a lot of the top 6 lenders are like swap rates will start to go up a little bit, but they want to kind of start the year strong, and so they're not really increasing their rates, and that erodes like their ultimately their margin, and margins can be tight in mortgages, as we were talking about earlier. So it's gonna be an interesting time, but I definitely think that it's gonna be a good time for homeowners, because I see in the next kind of 10 years the customer experience being a lot better, much more like an insurance product, which it should be in this day and age.
Seems like there's a future of Sprive where you potentially have a down payment. Well, actually, is that even like, I'm going to ask really dumb questions. Like, is it the same? I'm assuming there's a down payment. I'm assuming there's some benefits for a first-time home buyer. Is that true? In terms of like in the U.S., like you would have a 3% down payment if you're a first-time home buyer versus like a 10 to 20 or something like that, right? Are there kind of benefits in that way here?
So the bigger your deposit, the better kind of interest rate you essentially get, because obviously from a lending standpoint, there's less risk in the case of default. So that kind of works, but it's very crude. The way even in the US, I'm sure it's like this, but even in the UK, the way you price a mortgage deal and what rate you get is typically based on your loan to value. And these loan to value thresholds are based on like these 5% intervals. So if you're a homeowner with a loan to value of, say, I'm making this up, but like 89.9%, or you're a homeowner that's got a loan to value of 85.1%, you'd be treated the same and you probably get the same interest rate. But actually your income profiles and your affordability and your risk profile might be totally different. Why do they have to get the same mortgage rate? Yeah. Why can't you individually price on an individual by individual basis? Now, I know the reason why you can't do it today, but I do see a world where that could change, and suddenly you create a much more competitive marketplace where, in a digital platform, lenders are fighting for customers. That's kind of how I see the market moving.
Yeah, because that's unsatisfactory, isn't it? If you have to pay more for a deposit at a time when you're likely to be moving into a new place and then spending money on doing it up and things like that, then yeah, you're right. This banding is a bit strange, isn't it?
Yeah, I think everyone's situation is different. And the reason why they're doing is because they've got no structured way of like on an individual by individual basis, like verifying people. So they've got to have these crude mechanisms to be able to go, well, this bucket of people will give them this rate. This bucket of people will give them this rate. It's just because the technology doesn't exist. Everything's really like traditional legacy. A lot of distribution is from mortgage advisors, and when you're getting things manually inputted, you can't verify the information, you can't underwrite it. And like, there was a lot of talk about open banking, for example, and no lenders are really using open banking to like do anything interesting when it comes to underwriting. But it can be done. Like there's MCube, that have kind of done a lot. They've raised a lot of money and they've done a lot of investment in terms of trying to like end to end digitize the underwriting process for residential mortgages, for empowered mortgages. And so that's a really good use case where it can be done, but it hasn't really been done for any of the kind of the top lenders who have the balance sheet.
I mean, the devil's in the details, and what you're talking about is definitely the details. And I'm curious, so you alluded a little bit to AI earlier, and I may be taking us on a completely different tangent, but I'm wondering if it has anything to do with underwriting or anything to do with credit worthiness or anything along those lines.
I would love for it to.
Yeah.
But I just think that is not the way that we're going to see AI practically applied in mortgages over the next few years.
Do you think that's true here or true globally? Like, do you think regulations in other geographies could be low enough that...
I think so.
Okay.
Definitely. Right. And I know that there's a lot of sort of really interesting US platforms that are looking at automated.
Yeah, like Rocket Mortgage, I think, has some pieces that are like, they're less employees and doing more volume and things like that. But I don't know how much of that is actually like underwriting, though. That's the thing, is like there's a lot of smoke and mirrors involved in all this, and people are saying AI a lot correlated to a lot of things.
So let me tell you sort of what my view on AI is. And Ian, I'm sorry, you've heard me go on this rant so many times.
Great. No, I invited you back. I brought this on myself. So
I'm
there
a
you go.
total AI evangelist. Actually, our journey is 3 years ago. We set on this crazy task. There's this chartered mortgage advice practitioner's exam that you have to take to be able to provide mortgage advice, right? Okay. And it's actually really hard. Like, it's really hard, but it's multiple choice. And
All right.
I know that's a bit of a contradiction. And like the second module of it is literally, the third module is literally like case studies. Like, here's an example of a customer. It's like 3 paragraphs. What is the right advice to provide for this customer? And then there's multiple choice, A, B, C, or D. I looked at that and said, you know what, actually, let's get AI to now actually pass that. And there's a few people that tried before and failed, and we were the first ones to do it. So I could have made this big announcement in the market that, you know, Koodoo is the first firm to pass CMAP with AI.
Yeah.
Hoping that it would be, I'll be heralding in sort of a new time of mortgages and innovation.
What a time to be alive.
I remember seeing it.
Do you know what happened?
I don't know.
So
I need the punchline. It doesn't sound like it doesn't sound like what you wanted to happen happened.
Well,
I can imagine what happened.
if I was looking for a lot of exposure in press, I definitely got it.
Oh,
right. But it was like,
so it was negative.
it was like most of the mortgage market was like, why are you trying to take our jobs? The human experience is always better than anything that technology could do. This is ridiculous. It's probably fake.
Okay, so you hit on something really important that will change the industry completely, and Luddites got really scared.
Absolutely. I didn't actually get any death threats, but like I was worried at that point, right?
Holy shit.
But, you know, in a way, that was a really positive signal for me, because I was like, great, you know, and we actually have a reaction from some people. And I'll tell you my thesis on sort of human versus AI in a second. But then the next day, I got a call from my friends at the regulator, the FCA, being like, hey, Andrei, let's have a chat. And I was like, oh dear, the headmaster has called me into his office. I don't really know what to do.
The FCA is fintech friendly. I'm sure they offered you a coffee. You know,
Yeah. But you know what? Actually, I talked them through my entire thesis on it, and they were like, okay, great. We actually really like this. The direction that you're traveling in is a really responsible use of AI in the financial advisory space that really well aligns to meeting the new consumer duty standards that we put in. Because, you know, consumer duty is all about fundamentally, sorry, I'm going to be a bit cheeky here, the FCA not giving firms any rules on what they actually should be doing and just setting a standard for you should be doing a job and we're going to come and audit you at some point.
yeah, we have the CFPB to do that.
Right. Yeah. That's really tough on firms, and it's actually really disadvantageous for big firms, and actually I think advantageous for small firms who have a lower, like a bigger risk appetite. And what generative AI in particular allows us to do is now, like, compliance is so simple for us because every single call is monitored, transcribed, and then we basically have generative AI do our first pass of all QA across 100% of conversations. The traditional model is that you have a human looking at 5% of cases, listening 2 weeks later to a call and be like, was that good advice? Yes, no, checklist, yes, no. And you can imagine that if they spot something 2 weeks later, it's too late.
Yeah.
And they're only looking at 5% of cases. So what happens to the other 95?
Well, this is the issue with sampling audits across, like in the FDIC, as an example, the OCC, I think pretty much, yeah, I mean, the banking regulators in the US do sample audits, right? And this was the thing that I was always very confused by. It's like, we have tech, like I was working at a bank called MBKC. It's probably like 4 or 5 years ago now. Sub-billion-dollar bank in the US, but one of the top 15 mortgage lenders in the US, and like did a lot of veteran business specifically. And I forgot my point. Where was I going?
Sampling audits.
Sampling.
Yeah.
And so the FDIC came in, and I didn't know, as you can tell, I'm open to being dumb. And I was just like, how does this work? Like, what database are they going into? How much are they actually like garnering from that? Like, how far back do they go? Like, explain this to me. And the process didn't actually seem like you could, like, it was statistically significant technically, but the idea that you actually are getting an idea of the safety and the soundness of the bank from that is just like bullshit to me. Yeah, it's insane. But it's the only thing, like, with the human constraints that we had that we could do.
And the commercial constraints.
And the commercial constraints, exactly.
Totally.
So it just always boggled my mind that there was not more I mean, the core systems themselves weren't providing this technology. Anyway, it seems like there's some overlap there in terms of like the reg tech applicability in this way, this world.
Agree, right? Yeah. And like, I cannot imagine a world where we still have the same compliance frameworks that we have today existing in 10 years' time.
Yeah.
And I think that I'm certain, I really hope that the regulator is just going to say to everybody, hey, there's a better way of doing it. We expect you to meet this higher standard. And the regulator themselves should also be looking at this technology for their own supervision of firms, right? But let's deviate away from that topic for a second, because like nobody's going to win by being really compliant. That's not, well, you can lose by not being compliant, right?
Yeah.
But like that's not going to be your like competitive differentiation in the market, right?
Especially not based on, I won't shut the fuck up about the election right now, but like, especially not based on the world that we're about to enter.
Absolutely, right? It doesn't excite, I can't be like on my website, we have 100% compliance.
Right.
And customers be like, I'm going to choose Koodoo, you know?
They're gonna be like, you didn't? Like, they expect that, right? They expect you to do that, right.
Exactly.
People cared about FDIC coverage for about 2 weeks after SVB, and then they forgot.
Right?
Yeah.
But let's talk about what I think AI can change, right? So like, when I think about AI today, first of all, it's going to change. It is changing the whole world. There's no doubt about it. And I think it's changing it in two ways for businesses. One is just internal productivity. It sounds really obvious, and that's where everybody is focusing, right? Like we've just recently finished launching this amazing document review process that uses generative AI, and it's literally taken 20% out of the human cost of doing a case. Documents are just automatically reviewed. And that's great. So that means that, you know, my unit economics are a bit better, maybe good for customers because they might get a faster response. But that's just the tip of the iceberg, right? What I'm really excited about is when can you start and how can you start using AI to really differentiate your own customer proposition, and not in a way where you launch something where it's like, hey, I've launched Koodoo AI, it's our new chatbot, and it will do everything for you, but you just really seamlessly kind of slip it into your existing customer proposition so that people don't even notice it's AI, right? And one area I think for mortgages is it's going to be around document processing. Mortgages is still really heavily dominated by documents. All of our user testing, everybody says, oh, the documents were the worst bit.
The number of OCR conversations, back when I was at that bank, like that we reviewed so many OCR companies, and I was just shocked by like, nothing was actually getting what the document had on it, and it was a typed document. I'm like, how the fuck do you not, like, how can a machine not read a machine? Like,
hard.
this is crazy.
It's really not
hard. And luckily we're there now, but yeah, I mean, it's happened very quickly.
Right. So like, you know, the new customer proposition from everybody in mortgages has to be very soon. I know exactly what your case is. You're self-employed. You've told me this, this, and this. Here's exactly the list of documents I need right now. Upload them, verify them. This looks good. Great. Maybe even pre-populate some information further on in the fact find. That would be a bonus, so that by the time that the broker picks up those documents, it's all packaged. We even have this concept in mortgages called packaging, which is literally people who just check documents, put them together,
Take them to the other part of the bank, and then the other part of the It's crazy.
That's got to be be an ancient concept, right?
So playing like yes-anding to what you're saying, is there a version of what you're talking about in turn? Like, so you're telling them that you need exactly these documents. Is there a power of attorney, or is there an open banking thing there on top of that, where an agentic AI can go and get those documents for you in some number of years?
I think
or is that not really even where the value is? Like, am I forcing a power of attorney into a weird spot?
I think maybe.
Yeah,
I think maybe. Look, like when people come in to have a mortgage conversation, they're like, okay, £300,000.
They want to control.
Over 40 years.
Yeah.
This is
Yeah.
big.
Yeah.
I'm ready to do something.
Yeah.
And people submit documents anyway.
Yeah.
And we tried in the mortgage industry, right, to sort of force open banking in there. And there's some nuances as to why it didn't really work, and probably not worth going into. But people are just used to submitting documents, and maybe you don't need to force a step change in consumer behavior if it's not actually going to drive that much value.
Yeah.
But having those documents reviewed and validated straight away, that's powerful.
And a little bit of friction actually trust in a weird way, right?
Absolutely.
Where like if they're going to get the document for them, you're like, did they get the right one? I don't know.
Yeah, I mean, I was going to say, I think it all depends on which direction kind of the industry moves. So if you're, a lot of the AI use cases you mentioned is with the advisors essentially in the middle of the transaction, and there's because it's human power, AI can do so much to make that better and streamline the efficiency, improve customer service, and all of that good stuff. But if the world then exists, actually, there's a place for individuals providing advice, but is it in the more complex areas where people maybe got poor credit, or they
feels like hyper wealthy or hyper poor?
Yeah,
kinda.
that kind of thing where it's more specialized. That's when you've got the human kind of really adding value there, because it's really hard to like digitize and automate complexity. You normally start with things that are vanilla. And if that's the case, I think the AI kind of takes a little bit of a different direction, is the way I kind of see it. And so I think it just depends which way the market kind of moves. But at the moment, where the way things stand, it's very much what you're talking about, I think. But I do still, I'm a bit naive, but I do see a world where it's vanilla is very much more like a product transfer type journey, and it's much more digitalized. And banks, if you talk to banks, and they'll never publicly say this, but if you talk to some of the senior guys in the top banks and say, would you like a world where everything's digitized and it's very much like a product transfer experience, and you're not having to pay these commissions to mortgage advisors like you do today? I think they'd be quite happy with that, because don't forget, they own the customer as well. They've got current account customers who mortgage elsewhere. They've got that customer, so they've invested all that money, like we said, like the Monzos and the Revoluts, and a lot of them mortgage with their competitors. So they would love to be able to just not have to do that. And where complexity kind of is not there, why do I have to pay all these prop fees and things like that? So I do feel like when that happens, then it's AI plays a different place, and maybe it's more in the underwriting kind of lending space, because that's where the efficiency is. But as things stand today, where there's a total dominance, I think, with the intermediary and the human, I think exactly what you said is completely spot on. And I think Koodoo are leaders in that space.
Thank you.
It seems like there's enough inertia in the market though to sustain, a decent number of distributors and brokers. So what do you think needs to happen to really change that? Because they're not going to want to wish themselves out of existence, and they're busy sending angry messages about Andrei. So
I'm sure I'll get a few more after this podcast.
aim the please,
And does your regulatory framework actually lend itself to that power structure? Like, does the regulatory framework here make it so that it's harder to move?
I think that there was a term used quite early on by some of the kind of the early entrants that we mentioned, and that got the kind of the institutional investment, and they were talking about robo-advice. That word scared the living daylights of the of the kind of the people that are more, I'd say, who've been in the industry for a while. And now they're like, well, that's nothing to fear. And I think the regulator's quite nervous around it. What you don't want is, I suppose, 20,000 people, and suddenly the regulator approves robo-advice, and then they'll suddenly get a lot of people unhappy with them, unemployed, etc. And if it's not done in a controlled manner, we've seen in the past, like not lending irresponsibly, especially when it comes to mortgages, can lead to like real kind of market turmoil.
Turns out.
So it will take a very brave regulator to kind of like. Move advice out of the picture. But there is a concept like execution only, and it's a matter of how easy is it for a consumer to make a decision around mortgages, and I think the first time buyer process, I think, is very difficult there. But for remortgages, I think it's happening already with product transfers. A lot of product transfers are digital, execution only. People go, I've got a mortgage at NatWest, I want the best deal at NatWest. In the NatWest app, it says this is the best deal you can get. Press this button to get it. Within 20 minutes, you've got that mortgage. You tell your other half, I've sorted out the mortgage. Don't worry, and you have none of the kind of the pain points. And I see no reason why you can't create the same kind of experience just because you want to switch from a NatWest to like a Santander because they're offering you a slightly better deal.
Especially in an open banking world. Like if there was one portion of the conversation where I think open banking does make sense, it's...
Yeah, so I personally think an AI has got a lot to play there, but that's a very different kind of different space than kind of going and saying, this is the world that exists today and we're going to use AI to like improve what ultimately could be, if you were creating a blank sheet, that's not the way you would design if you were an architect, how you'd want it to work.
No, totally. Like you're asking about automated underwriting with AI. Like when I was putting together my regulatory business plan for the second charge lender, and we were explaining how are we doing our lending decisions, kind of AI kind of came into it a tiny bit, and I was like, how am I going to explain to the regulators who don't know much about AI the deterministic nature of our decision making in underwriting for something as important as a house? I'm just going to leave that, right?
Yeah.
Like, and try bringing generative AI into it as well, which is super probabilistic.
Yeah.
I think that's where the problem is, and also the structures by which the regulator expects affordability to be calculated. And this is why open banking doesn't work, really. It doesn't allow for you to look at somebody's bank statements. It needs you to look at their entire income profile, which requires your pay slips and your SO 302s. And that's why people kind of try to shoehorn open banking into mortgages. But it just wasn't really the right way to do it. And that's why we're stuck, as Jinesh was saying, right, with this kind of quite blocky, uninnovative approach to credit risk. In fact, I'd go as far as to say that there is no such thing as credit risk, really, in mortgages.
Risk is the wrong term.
Right.
Yeah,
It's
yeah,
like literally
yeah.
like.
There's credit decisioning, but yeah.
Totally. Like it's either like it's black and white. It's either you're in or out
Yeah.
for Barclays, you're in or out for Halifax, right? And then what's the kind of right LTV for you, the loan to value, because ultimately that's what they have to report back to the regulator on how
Yeah.
much they're holding on each loan to value. But if you really think about it, like how many people are defaulting on their loans and going into arrears in mortgages? It's absolutely tiny, right? So there's just no real correlation of kind of innovation in credit risk with mortgages. And as you were saying, Jinesh, bringing it back to the consumer.
Yeah.
There are a few interesting lenders in the market, like Kensington Mortgages, who are owned by Barclays. We work a lot with them, who are doing a lot more in the specialist space. And the second charge mortgage area is a lot more interesting because it's kind of a bit more akin to unsecured, where they have dynamic
Be a
pricing.
little more creative.
Exactly.
Yeah.
But it's a real shame because a lot of people come to me, they're looking for their first mortgage and they're like, hey, Andrei, like, gonna get my first mortgage, really exciting. Like, do I need to boost my credit profile? I'm just like, have you had an unsecured default? Have you had a bankruptcy? And like, no. I was like, well, it'll be fine then. But like adding 20 extra credit points to your credit score is not going to do anything. But everybody thinks it is because that's how cards and loans and everything else works.
Yeah. It actually is. It seems like it's actually quite different than the U.S. in some ways. So, to your question, the thing that moves the inertia. Again, I won't shut up about the election, but is the thing that pushes you all in a slightly more open direction? Us being idiots, right? Like that's an overgeneralization, and maybe I should rephrase us deregulating very strongly, very quickly. Like I think the idea that Dodd-Frank, a lot of the things post-2008 don't get rolled back in the next 12 months seems unlikely. Like it seems like that's the direction that we're going to go, and then crypto, and we're going to to the moon, the whole thing. So if we deregulate to that degree, and obviously it's not the safe and sound thing to do, but it's probably what's going to happen, and we're pushing the market in a certain direction, do the UK regulators react at least a little bit to open up a little bit, or is it actually just Americans are being idiots again, and we're gonna, as the adult in the room, just kind of keep steady for the next 100 years?
Nikhil Rathi, the current CEO of the FCA, had a bit of a funny moment the other day when he was on a panel and somebody asked him about just removing all sort of regulation essentially from mortgages, and he was like, yeah, okay, but then arrears will shoot up by 100%. Are you ready to accept that?
Right.
And it was kind of like him kind of throwing his toys out of the pram a tiny bit. But I kind of respect him for saying that, because obviously with regulation, it's just kind of a balancing act, right? And like we are in a world where we've had really, really low mortgage arrears. And for a government, for a government of a country where owning your house and holding onto your house is one of the most important agendas for a UK citizen, you really don't want to get that wrong. But unfortunately, at the same time, how do you buy a house these days? Where has Help to Buy scheme gone? Like, where is its replacement? How do you afford to live in London? I think there's quite a lot to do there.
Yeah. I mean, yeah, no, exactly that. I mean, it's the classic punchline, isn't it? You read the article in the newspaper how I bought my house, and then right at the bottom, I inherited 100,000 from my grandparents. Every single time. So you're right. There's a bigger problem there.
Yeah.
I mean, that's like obviously more of a political rather than because we don't build enough properties to, and so there's just not enough supply.
Yeah, you guys have a San Francisco problem. It sounds like.
And the funny thing is, like, there's so much land to actually be built on, but we've just got a political system where the minute you try to build on land, the locals just basically start.
Clarkson's Farm is one of my favorite shows.
Start pushing the government to
That's how I know about UK land ownership, by the way.
I think there's a stat that if any local council decides they're going to develop on a big property and they do it, they get voted out. Like it's
wild.
It's like and there's a reason, because the way when you got a land, I'm kind of digressing a little bit, but as soon as you sign that you can develop on this land, the price of that land goes up like 200%.
Yeah.
But none of that goes back into the community, and so all that this all goes into the kind of property developers' pockets. And so like communities just see that if someone's gonna build on this, all it's gonna do on existing schools, hospitals, existing infrastructure, there's just gonna be more people. And nothing's going to really kind of go back into the community, and so there's just a whole structural problem that we have that's never going to be solved anytime soon. Especially with when you think about kind of Keir Starmer and his policies. I've been in government a few times talking to politicians. It doesn't feel like there's anything kind of moving. They'd like to, but I don't think anything's kind of moving. It's a difficult political landscape to kind of navigate. And so it's I think if you either you marry well, or you like do shared ownership, where you got like 6 of you, like I'm talking like the average, like a lot of like the kind of the generation, like shared ownership is a big thing, or you've got parents who've got wealth who can kind of pass that on. It's challenging for a lot of homeowners, and we might get people say generation rent, right, for a reason.
Yeah, I mean, I recently got on the housing ladder myself, and I did
Congratulations.
Thank you.
True,
I
yeah.
just stopped
This
buying
is so
avocado
British,
toast.
by the way. Like this whole thing is just so British.
Yeah,
Like
so-
congratulations. Like
Hey,
Jesus.
no, we have a ceremony, like-
I mean,
Yeah.
it's like you would like housing ladder. You all use just some interesting terminology. Housing ladder makes me think of scheme, and scheme is another thing that we would know. Like you guys have regulatory scheme. All these kinds of terms in the U.S. generally connotate maybe some negative, like scheme's not a good thing in the U.S. You're you're thinking like somebody's scheming against you, sort of thing. So every time I hear about like a regulatory scheme or something, I'm just like, that's fucking hilarious. But
but
anyways,
it's
go
fun.
ahead.
The
Sorry, just
town
very
mayor
British.
rings the bell, they give you a certificate. The ombudsman comes
I just
down,
found
it's
out what an
great.
ombudsman was.
Yeah.
We're having a good
It
day.
all happens when you get on the housing ladder. You have to wear an outfit. It's great.
in a very strange country.
I feel like you're wearing like an ombudsman outfit. You're on an actual ladder. You're like,
Very much so. Hear ye, it's the ombudsman. That's what we do. To Andrei's point on Help to Buy, that was a segue, wasn't it? Help to Buy is an interesting one because that was notionally a way to get people onto the housing ladder.
What was Help to Buy? Was
the
it
idea is
subsidized?
You don't own all of your house. So someone else, a property developer, whoever.
Oh,
owns,
wow,
say,
BlackRock
50%
would love this.
You're buying 50% of it. You're paying rent on half.
Actually, it's the government that owns the other.
Oh,
okay.
Okay. I like that
And
one.
I did that. That's how I bought my house.
Well done.
Congratulations! Yeah.
Well, get up and do the little
Yeah, the jig. I've forgotten the jig. What do I do? Sorry, yeah. So, but when you did it, I mean, did it seem like a good deal at the time? Because I think the perception is that it's not anymore. But
No, absolutely. I mean, it was amazing for me because I was like, okay, get a mortgage over 60%, literally, essentially an interest-free loan from the government for 40% of it, which is frozen for 5 years. So it's just kind of, you don't do anything. And then after the 5 years, I just refinanced the whole thing. And I got to live in it in those 5 years. So
Why did we stop that? What happened?
It's a real kind of tale of two sides.
Sure.
It was really great for a lot of people because they could get on the housing ladder. Otherwise, they just couldn't afford it, particularly in London, where that 40% equity loan makes all the difference between being able to afford something or not. It's a big chunk. However, like even now, like when I bought my place, it was a new build, right? So kind of new development. And the property developers often priced up, knowing that people could suddenly afford them. And funnily enough, actually, like 10 years on since buying it, it's still the same value. It hasn't actually appreciated because there was a premium that was associated with it when I bought it.
Jeez.
And it's sort of taken a while for it to catch up. And that was a lot of the sort of the big negative frustrations on it. And also, my income fortunately went up over those 5 years. But for people that don't have an income that's going up, what happens if you get to the end of that 5 years and suddenly the interest starts to kick in and you have no way of repaying
Oh my
it
God!
back?
It's almost
That
like
can
an
trap
arm.
you.
It's almost an adjustable rate mortgage in some ways.
But
Yeah, it seems like the
it was
upsides are
good.
very significant, but also, and depending on the mortgage market, if your government ends up holding a significant portion of mortgage debt, I would say as an American, that didn't go great at one point.
They didn't like that.
It's how much of this is a UK thing and how much of this is a European thing? Because we're definitely talking a lot about Great Britain here. How much of this is like specific to the UK FCA type of thing, and how much it's hard to overgeneralize across the entire EU. But if I'm forcing you to, would you?
I think we should probably talk about long-term fixed rates a bit. Right? It feels like the right.
Yeah, I'm gonna say I think generally it's like this obviously in the US, right, where you've got like 30-year mortgages. It's quite UK's quite unique, and there's a few other markets, maybe Australia, but I might be wrong, where you like refinance every kind of 2, 3, 5 years.
It confuses me, but I get it. Like I understand it, but it's weird being.
But like obviously in the US and a lot of Europe, I think it's long dated mortgages where people are locking in 25, 30. Now 40 years is becoming much more common as well because in the UK people can't afford to kind of get onto property ladder.
Yeah, well, the salaries align. That's one of the things we were talking about in the previous, and I was having a conversation with a friend last night. Like the housing costs living, like, it's not like my coffee this morning was cheap, right? And like the number of people actually making six figures in London specifically, or just across Great Britain, it's like the math doesn't math,
Yeah,
guys.
I mean, it's like 1% of I think people in the UK earn a salary of 150K or something like that.
That
right?
was what I found out last night, and I
yeah.
didn't want to bring the stat up because I still don't believe it.
Yeah.
Like that's
Well, in the
wild.
US, I'm sure it's very different. Like,
Very different.
Yeah.
I don't actually know that. I should look it up.
It's 750, I think it is. So it's very very different. So going back to like 30-year mortgages, so it's that whole remortgaging thing is just super different, and so the market's just structurally different from what I gather. You can make overpayments and things like that. So like that concept of like putting kind of spare cash and stuff like Sprive does could work. There are people in the UK again. There's a fintech called Perona in the mortgage space who've got a banking license who are now selling 30-year mortgage products and trying to see if the market, UK market, could change and be a little bit more like a lot of the kind
So
of
you can do that's regulatorily. You can do 30 years. It's just that people are. What's the advantage of the 4-year refinancing? Like what?
You
Why
you get to shop around.
Okay.
I think there's just a culture of like shopping around for best deals. Like don't forget, the mortgage is like a big commitment, and so if you can get a slightly better rate, etc., it kind of makes a big difference in terms of the amount of interest you pay. And I think that concept of being able to shop around, it's going to be hard, I think, to like change that kind of behavior. I think in any kind of sector you're in, changing consumer behavior is the hardest thing. It's very, very difficult. It's very, very expensive. And in the UK, I can only speak for the UK, but people like shopping around for deals.
Yeah.
And so when you say that you're going to be stuck in something for the next 30 years, I think for a lot of people, they find it suffocating.
But if you could, you can refinance it.
Yeah,
just about any point, right? I mean, there's limitations there for sure, but like you can refinance.
No, and there's also another funny dynamic which the FCA have been trying to pick up on a bit, but brokers have been quite resistant to, is the entire intermediated market, which is where most of mortgages flows through, is based on a customer lifetime value. As a broker, that assumes that you're going to refinance that customer every few years, and you get a commission on that refinancing.
Well, that was the other thing. It sounded like there's a human incentive to the more often we do this, the better.
Yeah, exactly. Like if you think about it, like imagine you spend your whole, like for a mortgage advisor, their whole livelihood and the way they pay for their lifestyle is by making sure every month they're doing X number of mortgage transactions, and if they don't, then they don't eat. Like it's like a lot of mortgage advisors are self-employed, and so and their livelihood also depends on word of mouth. So typically, what people say is, you're looking for a mortgage advisor. It's a bit like you're looking for a plumber or
it's like like real estate agents in the US are that way, whatever.
And they already like don't touch the customer very often. They talk to them every like 2, 3, 5 years because in between their mortgage, what are they going to talk to them about? Like they've got a mortgage, they can't add any real value. They can you can check in and be like, how's your family or whatever. But in reality, you're in a deal. You can't really exit that deal without paying penalties. So they're already like not talking to the customer that much throughout the lifetime of the mortgage. So why would they ever sell a 30-year deal? Because that means that customer is a one-time transaction, and then that whole word of mouth thing's gone, and like you said, the lifetime value is completely gone. So. So then I don't know what like people like Perona, I don't know what their strategy is for acquisition, but. The world is they envision that in the US it's like this, and it's from a lending standpoint, it's very nice to be able to like not have to use deposits and use covered bonds to be able to structure mortgage deals and all of that good stuff. But it's going to be a challenge to kind of get over the kind of the normal way of how people think about managing and mortgage.
Yeah, I mean, if we look at the incentive structure, I find it interesting because I think a lot of people, having seen interest rates go up in the last few years, would have thought, I wish I'd locked in like 10 or 20 years when the interest rate's like 0 point something. Yeah, me too. Yeah, but isn't that partly because, there's that need to basically resell the loan, and at the same time for people, they want to shop around and, I can get 0.01 for 2 years. Why am I paying 0.23 for 5 years?
But the downside's just as intense, right? Like if the interest rates move in a direction that you don't want in 4 years. Like it was a buddy's house last night, and he was talking about how lucky he feels actually to own a home, right? Him and his fiance own a home together. They have, I think, 1 or 2 tenants, and he was talking about how lucky he feels. Yeah. And I was just like,
that is a lucky situation to be in.
That's wild. I mean, it's like I love it, and like I love him and the whole thing, but like in the U.S., that's like it's very different. It's wild that the limiting housing supply. It's like if we took San Francisco and did it across the entire U.S. It's wild.
Yeah.
I'm so stuck on the fact that like
And it's going to be a really systematic issue for any government that comes in the next few years. And I'm sort of saying that with showing you potentially some of my thinking about what might happen in the next few years, right? But like housing has always been at the top of the government agenda. And frankly, it's really disappointing to see them having done nothing.
Yeah, I mean, the last in the UK, the last kind of like town that's been built is Milton Keynes, and that was like 20 years ago, as an example. So nothing's really happened since then. And I was at school when that was happening. So
do you guys also have like height limits or anything inside of London where there's issues in terms of building taller, or is it just a matter of like the buildings are fucking beautiful and historic and we don't want to tear them down and build high rises? Because that's the other thing we would do in the US is just go up.
yeah, I think there are certain limitations on how tall you can build it, like in suburban areas.
Okay, yeah.
Because there's like, even if you're like you got a residential property and you want to extend it a little bit, etc. There's a lot of hoops you need to jump
Again,
through.
Clarkson's farm knowledge.
Your only source of cultural.
I talked to Ian and I watched Jeremy Clarkson on TV.
That's pretty representative.
Fair enough. Yeah.
So I imagine like loads of people, if suddenly huge towers started coming into like a certain suburban areas, then you get the same reaction where people say that's an eyesore and the councillors will get inundated with.
It's literally San Francisco.
Local people being like, I don't want this in our area. But I don't know if there's anything. I don't know if there's any kind of regulation, but I think you have to go through approval and that.
Yeah, and also the trick is to live in an eyesore that overlooks a historic area that you're not allowed to build on. I think that's ultimately what you need to do.
That actually does seem like the win.
Yeah.
So you can't see it back, right?
Yeah, exactly.
It's all glass. You're just looking out upon history.
We're not helping ourselves as a country. Like you either find land that no one's using and you build on it, or you find existing land and you build up. Those it would seem like two kind of very lateral ways of like trying to solve the problem. But it's become political, and things need to structurally change. And no government has yet come in and been like willing to like, be bold, like do some of the things that maybe is happening in the US where actually it's like this is the way it's worked, and actually we're going to rip up the kind of the playbook and we're going to just go bold.
How would you change the mortgage market?
Like from a housing point of view, right?
Yeah, because obviously build more houses is straightforward, right?
Well, I don't think it is, right? I think
well, as an idea, as a concept.
What needs to happen? It has to be one of two things. I can only see it working one of two ways, right? All of the big developers have 20-year planning horizons because it takes a long time to develop an estate, get planning permissions and all of that, right? Each government has a few years in term, right? They're just fundamentally mismatched. Yeah. So each government is terrified basically to grab the developers by the neck and say, this is what you're going to do, because it's not really in their interest from their term, right? So either they need to do that, and that might be fun, or they need to just build their own houses and just do it publicly again, right? But again, if you know you're only going to be in term for potentially a few years, so actually, for me, the housing issue is just fundamentally the problem, the root cause of it is this mismatch between the planning horizon and times that it takes to build housing and the terms that existing governments have in office.
The incentive alignment across the whole conversation is a thing, right? Like just the money makes people move different directions. And the other thing about it is like it's fascinating. Ian, how long have you been in Money 2020 now? 2.5 years? Do you feel like when you started, we were talking a lot about like technology and finance? Because I do, and I feel like
for sure.
Like now I feel like we're talking about politics more than I've ever talked in my life about politics, policy, regulators. Like it's a bizarre.
All the time the technology arrives, but the actual difficulty of implementing the technology is people.
Yep.
And it's government and it's regulation. So I think that's where we're at.
And to answer your question, what needs to change for the mortgage industry? I think it's twofold. I think one is the top 6 banks that lend in the market. They have a huge market share. They need to like shift. And there needs to be something. There's 2 reasons why they'll move. One is either threat from like a competitor, or they'll see some sort of opportunity. And again, they're worried that another competitor might capitalize on that opportunity, and so they'll kind of try to like fight for it, and I think those two scenarios I think would probably change the industry the most. And then from a regulation standpoint, the regulator, it would be nice to see them. I think like there was a period, maybe going back like 5-7 years ago, where the regulator was a little bit more like, how do we innovate? They wrote a really nice paper back in 2019.
We all miss Nick Cook.
Which said
I think that's what it
the
is.
mortgage market was broken, needs innovation.
Yeah.
And then it's gone a different way, and I understand why. And consumer duty is something really important. It's really important for us as a business, and our whole focus is trying to reduce down debt. So I think we're definitely kind of achieving that. But the more, if the regulators, because not that many tech players in the market, if the regulators can like go, look, what could be done? How could we do things better? How could we get better customer outcomes? But also make sure that we do this in a very controlled way with technology changing so fast. That would be amazing. I don't see a lot of that happening. So a few things need to happen for that to take place.
Yeah. It is a very political thing, though, right? Because at the end of the day, like, consumer duty, if taken from a governmental perspective, would probably be to build more housing, right? Like that would rational alignment would say build more housing.
Thing to do for the UK, hands down.
Right.
But then for Andrei's point, that ends up being a line of expenditure on your budget sheet.
Yeah.
And 20 years from now, someone inherits that and like, oh, look at all the houses we just built.
But also, I think, not to go a negative direction, but I think, the UK is quite good at creating regulation that causes money to be spent in a certain direction on humans or something. Like the idea that the limitation there is that it's too expensive or what. There's so many other versions of that we do that you guys do, that are no issue. That all of a sudden it's an issue right here, right?
Yeah, I also think like the experiment in the US is going to be really interesting. I'll call it experiment. Hopefully
It's fair to call it that.
No one takes offense.
I think I called us nuts earlier.
The kind of the executive kind of like policies that Trump recently signed was like deregulation, there was like AI, and there was like data, and we want to be the leaders in this and leaders in that. And a lot of these spaces where UK has a bit of a strength historically in kind of technology and obviously if it goes well, then there'll be other governments around the world going, we probably need to do something as well, because it's happening in a very like public way. And so there's people in the UK almost thinking, well, is that a good thing? Like people just kind of ripping up the playbook and being more aggressive. And if politicians don't move, they'll look for people who are more like Trump in the way they operate. And then things will start to shift. And so either the existing players need to shift, or they need to, or someone else will get elected in that will be very much more of the Trump mindset. If it goes badly, then the kind of people in power now will be like, well, Trump told you,
Yeah.
like, what was he thinking? He's mad, etc.
Right.
So I think for innovation, Trump's policies, if they are effective in the US, I think that will change the world. So it's an exciting time. And some would say it's quite nice to have an experiment, not in your own country, and be able to look from afar.
Thanks.
Thanks,
guys. Cheers.
But I am
Cheers.
personally rooting that it is a success, because I think a lot of governments have got too stale, and sometimes it takes a different approach. But on the flip side, it could go wrong.
And we're actually seeing that play out right now in the UK. I don't know if you guys heard about the Santander controversy in the UK. So basically, a few years ago, there was this huge ruling by the High Court that a lot of financial institutions had missold motor finance to their customers because they were failing to disclose broker fees, basically, massively simplifying it, right? And Santander was really exposed on this, like really exposed. And they got really angry, and they just said, okay, we're pulling out of the UK. Completely, right? And there's like, I don't know where the kind of rumors have got to now, but Santander threatened to just leave the UK entirely. And now Rachel Reeves is running around kind of tearing her hair out, being like, oh, well, that's going to be bad for consumers, isn't it? But it's such an interesting kind of playing out of what you were just talking about, Jinesh, right? Of kind of potentially not very pro-business environment in the UK, leading to businesses just voting with their feet and just pulling out and having a terrible impact on consumers in the end.
And there's a lot of like I don't have the stats around this, but anecdotally, people who are leaving the UK that have wealth because they feel like UK isn't, as
It's not a tax haven.
it's not a tax. It's not a tax haven. Some people feel like it's not pro-business, and so they're moving to like Dubai.
Yeah.
And a lot of fintech. There's a lot of fintech like CEOs. Whether some of it's talk, some of it is posturing, some of it is real. Are moving to the US. We know some examples of people who've done that. So, what you don't want is the UK government, all of them talking about growth. And
then you have a brain drain.
And we've seen a brain drain.
Yeah.
So the people need to like react. I think that we're obviously hoping that the government, obviously Labour's new, and they're trying to like find their feet. But they've got a good few years to be able to like make a change, and there's a lot of opportunity. There's a lot of talented people. And we're spending a lot of money. You could they're trying to do, obviously the Labour government. Their kind of the budget was very much like increased spending. And if they can be like, you've got the Dodge in the US and be more efficient. If you're more efficient and it works.
I recommend a rebrand if you're going to try something similar. But yes.
But again, if that's more efficient, then more efficient government could lead to like positive things for sure.
It's gonna. I do wonder if I am also hopeful that the experiment goes well, for my own sake and for the sake of the world. I mean, it's one of those things where I don't really think there is a middle ground, right? Like at the end of this, like it either goes really well or really poorly, and the rest of the world reacts as a result, right? Like they're 4 years, 5, 6 years from now, I think it's a forcing function, right? Like just how can, then this is a question that we've had bunker days of just talking about like European Money 2020 content that we're going to talk about. And one of the questions I keep coming back to is like, how do rational actors, AKA the UK, the EU, function and compete in an irrational world, aka the world? And it's like, I don't know. I really don't know the answer. And it's maybe the world gets so irrational that the rational actors are forced somewhat outside of their rationality into a little bit more creativity. I hope that's what it is. And then like, I feel like the EU ends up in a middle ground and the US is just like, to your point, this experimental thing.
But I think it kind of is a bit of a wake up call, is that some of the things have gone too far, like and becomes, because you build it like you build up like processes and policies and regulation over time, and like a bank, you add on layers on top of each other, and before you know it, it's just become a beast, and now it's an immovable beast. And so sometimes you need a sledgehammer to like it's the only way forward. I mean, I've worked in banking organizations for a long time, and even ones that are very, very entrepreneurial in the way they run their businesses have a lot of layers in there, and it's hard to like just transform, because when you're running a business, whether it's private or government, you've got to run it, and to change something you're running and it still needs to like service is very, very difficult.
It's easy to say from the outside.
So it's easy to say from the outside, exactly, but it's practically is very, very difficult. So I think the only way you can do it is with a wrecking ball, to be honest, but just making sure that the people that are in charge of the wrecking ball, if they can do it, are like of sound mind.
Or you just put the wrecking ball across an ocean, and you just see what happens over there, and then whatever makes it across.
Then you got some really analytical people analyzing what worked well, what didn't, and learning from it. But it's an exciting time.
You just made such a case for being an entrepreneur at this point. Like it simultaneously is an incredibly bearish moment, but if you look at all of the different variables that we just laid out in terms of like the U.S. does this experiment, potentially things open up a little bit. It seems like we're on this like not even tipping point, like inversion point almost of banks going tech instead of.
It could be amazing if like AI, you got AI, and then you've got like this whole kind of impetus of like actually technology innovation and efficiency and maybe even deregulation that creates huge amount of opportunity. I think. You think about the entrepreneurs that are out there, they want to solve problems and they want to be profitable. And let's face it, there's a lot of problems to be solved, especially within government. And so obviously not talking less about mortgages here, but I think it's just a really, really interesting time for anyone. I just got to kind of watch the space, but it could be really exciting.
And hopefully all of the sort of the difficulties of being an entrepreneur of the last few years are behind us. I mean, it has been a real slog, right? We had COVID, then we had inflation, then we had SVB. And it's just like one thing hitting after another, right? But now at least, touch wood here, we can do our little dance as well. That's what we do in the UK.
Touch wood and do a dance. Okay. All right. I'll get you that t-shirt too. I'm getting him a lot of t-shirts made today.
Hopefully now, like, all that we have in front of us is opportunities that are created from instability or from some government policy changes that people can capitalize on, rather than just barriers to doing business, which we've seen quite a lot in the last few years.
Yeah, but I think people are frustrated and they want straightforward answers, don't they? I mean, whether or not policy ends up being right and deregulation ends up being right or wrong, yeah, people don't really care that there's layers of regulation. They just want their human need met. I mean, we're talking about the UK. Salaries are depressed. People are moving to the Middle East. By the way, we've got a new event in the Middle East this year. You know,
Link in the show notes.
nice. Yes. But it's one of them things, isn't it? Like, people's needs are pretty straightforward. At the end of the day, people want to own a house. So yeah, something does need to change. And bold messaging is probably the best way to speak to people, because people are pretty frustrated.
And people clearly respond to bold messaging pretty well, as we've seen from our experiment over the pond.
Yeah.
And we will have to do this again in like a year or a couple of years and see how the experiment's going.
That'd be amazing.
Yeah, I think we're going to have to do this again.
Politics can be quite dry, but what's happening now is I'm just like so hooked.
What's the point of watching like like a Netflix series or anything like that? It's just, you just turn on the news.
Yeah.
Like it's
100%.
a wild time to be alive. Guys, thank you so much. Ian, appreciate you. We will do this again in a year or two and see what unfolds.
Yeah, cheers. Thanks for having us.
Thank you for having us, Zach. Thank you.
Cheers.
Pleasure.